All right, hello, and welcome to our Lunch and Learn. It's a little different than we are hoping to do. We'd love to see you guys all in person, but we appreciate you joining us today, and we're hoping that you can get something out of this. Just a little housekeeping as we get started, and I know it was posted in your chat, but you guys are all on mute right now, so if you have questions or something that you want to address, type it in the chat box, and we will get to those as we move along. First, Horizon Investments is joining us today, and they're going to partner with us in this Lunch and Learn webinar. We've had a partnership with Horizon for going on 10 years, and it's something that has really become a really great relationship. Not only do they manage assets for us, but we've got a consulting relationship, so we work on a number of projects together. And again, we've just developed a really great relationship. For those of you that are Ferris employees, they're a primary manager on our Ferris management, and obviously in our portfolios as well. Today we're going to talk about the markets, the economy, what's been going on, what might be next, and what we foresee as what's going to happen maybe moving forward into the future, and how that looks. And really the biggest piece of it is what that looks like for your goals and your planning, and what phase of the investment journey that you're in. And so we're going to touch on how it impacts each of those phases along the way. If you do have questions, again, like I mentioned, please type those in the chat box. We'll get to as many as we can. With some compliance issues, there may be some that we can't get to, but we will do our best to get to as many as those we possibly can. Now I'm going to turn it over to Brad to introduce our presenters for today.
Yeah, so today we have Danielle Lerner, excuse me, and Robbie Cannon from Horizon. We're very happy to have both of them with us. One thing that we really enjoy with being an independent firm is we're able to partner with other firms that we really enjoy working with and can bring more to the table than just managing assets, and that's definitely Horizon. Danielle is our contact on the consulting side. I would say she keeps us organized. We talk to her generally once a week, just to kind of make sure we're still moving forward on projects, whether it's research or whatever it may be. Robbie is the president and CEO of Horizon Investments. Started in the business in 1994, I believe it was, has owned Horizon since 1999. Since Robbie has taken over Horizon, has really gone from a small kind of regional RIA firm to now it's a multi-billion-dollar asset manager, doing consulting, doing lots of things. For us, consulting, again, they do research, they do those kinds of things. So they've been a great partner of ours. So we'll turn it over to Robbie to get us started.
Hey, thank you, Brad. Thank you, Nick and Danielle. Certainly remember that chat feature from a Q&A standpoint. I am going to have some breaks in the conversation, so you're not going to hear me lecture. What I do want to do is try to probe some of the more interesting questions so it sparks some conversation. That said, thank you so much for joining us. I hope you're safe and well. This is anything but a normal time, but I know Big Rapids still has some flurries, and we joke about that as we're in Charlotte, North Carolina, and we're starting to see glimpses of spring, which is actually quite helpful in this type of environment. We are going to talk, Nick mentioned goals-based and talked about the different phases. As we talk about goals-based solutions, we always set it in this conversation around the investment journey. And so what we have done for Lerner and what we do is try to work with this idea of building wealth, securing wealth, and really enjoying it from a retirement standpoint. And as you could expect, in times where markets get more volatile, the partnerships are really important. And so what it does is spurs a lot of conversation. I know that Brad started with that there's conversation once a week with Danielle. I would say in times of market uncertainty, Brad and our team and really the team there at Lerner, Cerny and Fath are talking every day to our team about what's occurring and obviously the potentials in regards to the markets. The conversation really is in three parts. First, just to kind of lay out the context of what we're seeing in the marketplace. but I really want to center most of the content around what it's going to take to get back to work. And so there's a lot of conversation, especially in Georgia and South Carolina, around where we live as far as opening back up. I think there's some things that we need to see in order for us to feel comfortable that this is more normative and not necessarily this break from a states' rights or some sort of political type environment. So we'll get into that. These are some words that you're going to hear a lot, probably even as there's post-mortem done in terms of what took place over the last couple months. Let me just define our terms as we get into this conversation about the markets. One, risk is something you can measure. So if you can measure it, you can manage it. And so risk is something that's typically managed, whereas uncertainty is something you can't measure. And so by definition, it's not something you can manage. It's something that you're trying to get more information so it can become a risk. So, when we went into this last month and a half, the risk to the market was really what was happening from a Democratic Party standpoint in terms of the U.S. electorate. So we had Bernie Sanders surging, and the question was, is this who was going to be the rightful heir from a Democratic Party standpoint, and certainly what was going to happen. The other really important risk that was in the markets was this idea that the U.S. had grown over the last 10 years, albeit slightly below what we would say is trend growth, but it had grown, and markets were at historic levels over the last 10 years. And the question really was, well, what's going to bring that to an end? And so it was those things that were hitting the market as risk, and asset managers like Horizon and like Lerner were talking about how to manage that. We moved quickly into uncertainty with the question of a U.S. economic shutdown. So no one had ever seen that. That was not well defined. There was no playbook, for example, with a situation like that. And so these risks were kind of set aside for the more important understanding of this uncertainty as it relates to the U.S. economy and its shutdown. Not only did we see it shut down, we saw all-time market highs, all-time market high in volatility. And so then you had that yo-yo effect. So some of you that were watching CNBC or maybe another news program and you saw the markets down 3,000 or 1,000 or up 1,000, that yo-yo was due to the heightened volatility that we saw. And we actually saw more volatility than we did in 2008 during the great financial crisis. Not only that, recently, but also even back a month when there was conversations about oil markets in regards to Saudi Arabia and Russia, we saw some stress in the oil markets early, and we really saw what we can only call a collapse here, and even in the last couple days, whereas energy actually went negative, meaning that the ships full of oil had nowhere to offload the oil. So very interesting times we live in, but that's the context that we set out. So what the markets are trying to sort through right now is, from an uncertain standpoint, what are some numbers and figures that we can attach to some of these things that we didn't really understand, so that we can actually translate them into a risk that an asset manager and a firm like Lerner, Cerny and Fath can actually manage. So with that, let's talk a little bit about the market itself and just the dynamic that took place over the last month and a half. You actually saw on the left-hand side is the speed of that crash. So the 2020 mark is the first one that you'll see. It's the fastest market decline of them all. In fact, I don't have the depression up, but if you put the depression there, you would actually see 2020 was actually faster and more volatile than even the Great Depression, which is just, it helps put everything into context. And the reason why it was so fast and so volatile is because of that uncertainty. It was very difficult to price anything back a month and a half ago. So let's look at this quote, though. This is a large energy company, Schlumberger, multinational corporation. The CEO Olivier Leponche, talks about this idea of a double black swan. And I think this becomes really important as we talk about the markets, because the question you might be asking is, okay, so what is a black swan? A black swan is a statistically improbable event, meaning it shouldn't statistically even happen. It's that 1 in a million chance of the horse winning the race. It literally should not occur. What he's saying here is that not only did he see one, but he saw two. And I think that's a really common theme that you're going to see from executives. If you asked any large company, whether it's a large bank that you might know the name of, to even a smaller firm that is looking to maybe get some PPE money or maybe small business administration money, the question of black swan is really something that hit their business for the first time, probably since the great financial crisis. And it didn't hit it once. It might have even hit it a couple times to try to get your bearings. And it's that kind of situation that translates into the market activity that we've found. That said, when we talk about market activity, there's an underpinning of economic facts that are occurring or eroding up underneath the surface that is causing that market reaction. So we talked about uncertainty. So what is the biggest element of uncertainty in the U.S. market shutdown? It'd be the consumer. And the reason why that is that 70% of the U.S. economy is centered around the consumer and consumption itself. So let's contrast that with Saudi Arabia, whose economy is wrapped around energy, obviously oil. So very differently, the U.S. is actually wrapped around consumption and the consumer. So it actually does really well in times where energy kind of moves up and down, but it doesn't do so well, obviously, in the midst of a shutdown. And I'm sure in Big Rapids, very similar to Charlotte, it feels like a ghost town in a lot of places, obviously with restaurants and small businesses that are just simply shut for the time being. But what we're seeing here is that not only consumer confidence, you're seeing that chart on the left with a drop, and this is going back 10 plus years. And so you're seeing very steep declines even from where the great financial crisis was. That's also translating into investor sentiment. So what does that mean? It means that if a consumer is not confident, then they're probably not going to be all that excited about the market. And that might be something that you're feeling. Certainly when you turn on the news, you hear negative news about probably politics in general. You probably hear news about, obviously, Corona and its impacts. And then you're going to hear small business impact. And then you're going to obviously be associated with that as you just live your lives. And so that's going to translate into how you feel about your investments and whether you want to participate in markets or not. And so, again, no surprise here, but because the economy is wrapped around the consumer, it's very important. This also dovetails into a market event that you saw just recently where the market was down about 34%, 35% at its trough, and the market jumped back. So you see these big moves down, and then you obviously see some very sharp increases in value. And I would say that that's not necessarily Mr. and Mrs. Public in Grand Rapids or in Charlotte buying securities at low levels. That really is a market dynamic called short covering, and that really is just a function of how bad things have gotten. So there are some things that we're going to look for, and we're going to propose for more stability to come back into markets, and things that we need to see for things to get back to normal. But the consumer is definitely one of them. As we talk about the damage, just again briefly, we could show you a lot of different economic indicators, but the reason why the consumer is so important is because they're a central place here. And you're going to hear continued initial jobless claims go up. So unfortunately, we shouldn't be surprised by this number. It's about 1 in 10 now So 1 in 10 households is affected, about 10 million unemployed. And the plus is there because it probably will get worse week over week for some time. Remember, a market recovery will happen before economics actually recover. So it is a discounting mechanism to what's occurring. The economics are actually what is actually occurring. But from our standpoint, obviously, this is something that we need to see slow down in order for the consumer not only to feel more confident, but also for investor sentiment to come back. But this is going to translate into what you're probably hearing a lot about, which is economic numbers. There's a lot of conversation around a recession and that word. So let's just talk about and unpack what that might mean right now. A recession really technically is 2 consecutive quarters of negative growth for the U.S. And we don't have second quarter numbers, obviously, because second quarter will end in June. But I don't think we need much more information to just suggest that we are in a recession. So we are in a recession. We've been in this type of market decline in terms of growth for a little bit of time now. And so the question is not whether we're in a recession. It really is how deep and how long that recession will last. And so it's very interesting to us as market technicians, and obviously to Lerner, Cerny, and FAF as technicians, to think about the conversation now versus maybe the conversation that was taking place even 2 months ago in regards to these figures. So just to kind of highlight what's happening now is growth might come out at 2.7 or 2.8 as a hypothetical example. Right now, and that 0.1% would actually be argued about, and it would actually have market implications. But today, in this environment, what's actually being talked about is not whether the market will be at 2.8 or 2.7, let's say, but whether it'll be negative 10 or negative 20 in terms of the trough on growth. So, you know, in terms of arguing, you're arguing tens, not decimal figures, which is highly significant, obviously. But as you can imagine, I have forecasting up here for a reason, is with any type of system, if you put garbage in, you're going to get garbage out. And so right now, there's just not enough known to put enough variables in to make sense of some of the numbers that are coming out. So as we look forward, what needs to start happening is these uncertainties in terms of the consumer, their health, their outlook, and certainly the investor sentiment itself, GDP numbers themselves, how the consumer is operating, whether they're employed, those uncertainties are having to translate into risk themselves. So with that said, I might just stop here and pause just to say, before we look forward, and what we're going to do here is kind of define out the 3 things that I think we need to know before we start to talk about getting healthy, which is the corporate, whether we're going to get back to normal from a corporation standpoint, small business, for example, the consumer themselves, as we talked about, and certainly the cure. There's a lot of conversations about what's happening between private industry and government in terms of launching trials as to drugs that they're testing. So that conversation I'm going to peel off on the side right now and just kind of focus in on the damage that's occurred as of right now.
So Robbie, we had a really good question. You know, we've heard some things from clients that, you know, I really thought I would never hear, buying gas for less than $1 a gallon. I actually had a client fly back from Orlando for $4 one way from Orlando to Grand Rapids. So just things that all related mainly to oil. Can you just talk a little bit about why that's a great thing when you fill up your gas tank as a consumer, but not necessarily for the economy, a real good sign?
Yeah, so I think that's a great question is what's occurring in the energy sector and what should we learn from it? Certainly there was conversation in regards to the oil markets themselves. Remember, they're run by a cartel of countries. Russia and Saudi Arabia, being some large suppliers, had a disagreement, and so said, hey, we're going to flood the market with oil. Certainly that hurts states like Oklahoma and Texas, but also up in the Dakotas where there's fracking. It hurts. It's going to hurt those states. Certainly the low prices on energy. That said, oil prices themselves, as they translate into gas prices, remember, it's not a one-to-one translation. So when you see oil prices strike new lows, think about a couple weeks out where you'll start to see that impact at the pump. But it does act as a tax cut, so a stimulus to the economy, because the economy or the consumer themselves has more to spend because they're not spending as much on gas. I think the same thing if food prices came down, you'd have more to spend on something else because you weren't spending on food and gas. That said, this is a little different. And so the black swan, the double black swan that Schlumberger's CEO was talking about is really demand and supply destruction, where you have all this new supply on the market, but from a demand standpoint, there's not really a whole lot of driving, and certainly the airlines have dried up, cruise ships have stopped traveling, so you have this double impact. So from an energy standpoint itself, we would expect it to be fairly weak, even if you look out in the futures market. Oil itself as a commodity is fairly weak for some time in the future, and it's really because everybody is at full capacity in terms of having energy reserves. Obviously, as economic activity continues to pick up, you will see that price eventually start to increase, but I think it's going to be a slow go of it, and so you're going to have suppressed energy prices for some time, which as we get back to work is going to be a good thing for not only the consumer, but also for the economy, because it's obviously more dollars in our pocket. So great question there. In terms of the energy markets, has a little different effect, obviously, if you're tied to the energy sectors themselves in Texas, Oklahoma, the Dakotas, and what have you. So as we look forward, and again, I welcome your questions in the chat room, as well as we stop at this next point to talk through them. But let's actually engage this conversation. Not only what do we expect, or when do we expect things to get better, so put a time frame on it, but what are we watching? And so I want to throw this next framework up because it really is an economic framework that underpins the market. And so I can't emphasize this enough, is that what you're looking at is, it looks like the Big Dipper, but really it's this idea of how deep and how long is this going to occur for. And so at the beginning of this exercise about a month and a half ago, we really didn't know anything. We are starting to know things, not only from a political standpoint, but also from a business standpoint, of what things are starting to look like in terms of getting back to normal. But here is the question, though, because the question is one of, is it just a liquidity issue, meaning does the market just need liquidity? So if you think about the Senate just passed the $500 billion of extra PPE money. Certainly there's been more fiscal stimulus added to the economy as a result of small businesses having to shut, certainly airlines having to shut, most travel shutting down. But the real question is one of duration. So we can kind of understand what a shutdown looks like. We can't understand what a duration looks like because a liquidity event could very easily become a solvency event. And what I mean by that is Jamie Dimon, head of the largest bank in the world, JP Morgan, talks about small business. And I think about Big Rapids just like I think about Charlotte. If you walk down Main Street, you look at all these small businesses. And what Jamie Dimon was talking about is that each of these small businesses has on average about 15 days of cash on hand. And so if you think about duration, that's actually pretty significant because a liquidity event could very easily become a solvency event. And that's what we don't want to happen. Certainly, that's why the federal government is acting as quickly as it is. In fact, it's certainly got the message because with all the Federal Reserve activity as well as all the fiscal stimulus that Trump and the Congress has passed is a result of this juxtaposition between this idea of liquidity versus solvency. So we would say that's the framework that we need to think in terms of getting back to normal. But in terms of getting back to normal, here's a slide that's actually pretty optimistic. This is a slide from China. It talks about Chinese activity. And certainly you see the drop-off like you saw in the previous slide where you have a shutdown. And now we're starting to see the other side of the handle in terms of the duration. But let me just mention a couple anecdotes, and then I'll mention some figures. In China, what we just anecdotally know is that we know Apple shut about 42 stores countrywide, and that was shut about 2 months. They've all reopened, and so if you look at pictures of stores, there are actually individuals in the stores buying actual product in there, which is super helpful. Not to say they're still distancing. There is still some qualifications in place. The other anecdote would be Disney Shanghai. Disney Shanghai also shut as a result of Corona. They have reopened as well. Again, qualifications, but they still have reopened. And it's been about 2.5 months. And so when we're looking at something like this, and this is based on geolocation data, so what WeBank does and what other big data sources. So you might hear big data. It's not Big Brother. It's just what are some data sources that we can pull from to look at individual facts about this getting back to work. And what they're seeing is in these geolocation type numbers, they're looking at pollution figures. So think about pollution shutting down. You see no pollution, right, because the factories are shut. And then you start to see pollution rise, and then you start to see it at a level it was. You can do the same thing with monitoring traffic, right? You see zero traffic, and then you see, well, is traffic getting back to normal? I think what we're seeing, at least from a production standpoint out of China, in the same time period, from an industrial production standpoint, they are back at pre-crisis levels. Not to say that there aren't ramifications in regards to opening, and they still have some qualifications in terms of how the consumer is interacting inside the store or inside the amusement park, but to say that they are opening. So that gives us some sort of frame of reference. I think one of the sectors that also is super interesting to talk about is just the cruise industry. You may have booked a cruise this summer. You may have had to cancel, or an airline flight. And so what are the airlines and or the consumers looking at? And I would say a couple points of reference would be Royal Caribbean and certainly Carnival Cruise hit substantially. Again, you have the big sharp drop-off, no cruises. They are looking to reopen mid-June. So you've got one around June 12th, the other around June 26th, where they're starting to take bookings again. So again, really helpful that you're starting to see this activity start to creep up, not the least of which you're also starting to see it in states like South Carolina and Georgia. Probably we will also start to see this in North Carolina as well. So I'm going to talk about corporations, consumers, and the cure, but let's pause there for any questions in regards to what we need to see for us to get back to work.
Yeah, Robbie, I think one thing that has definitely popped up a number of times as we talk to clients is, and you hear when you listen to the news, do you guys think that we have one more big push down before we start to fully recover? Is there more lag left, in the market, or do you think that we're, kind of stabilizing, waiting for a return at this point in time?
I think that's a great question, and I think one of the ways we answer that question is pushing through to this idea of the cure. And so anything that we're talking about, because of the pharmacological developments, in regards to COVID-19 and finding a cure. Obviously, we've got to caveat everything saying that there are developments occurring. I put two that are occurring, one in terms of Johnson & Johnson, the other in terms of Gilead. Gilead is a stock of biopharma that actually has gone up 25% from a stock standpoint as the market has obviously declined based on this idea of their ability to find some sort of solution. There are a number of companies hunting down, as you can imagine, the solution to this. We believe that a solution, I'm not sure is imminent, but it's certainly on the horizon. And here's a couple facts about what's occurring. One, we have a 30-year veteran of this industry from an analyst standpoint telling us that never before have they seen a partnership and collaboration as they've seen today with the biopharmas and pharmacological advances with the government, meaning never before has the government been this effective at its partnership with private industry. And basically what the government is doing in terms of the FDA and the clinical trials is getting out of the way. And so we're seeing that across the board, whether you're looking at the Chicago hospital from a Gilead standpoint, or you're looking at the R&D and manufacturing standpoint from Jensen and Johnson & Johnson. So really excited about that. I think the question in terms of the actual market numbers is answered in the second slide. So we do look at pharmacological advances as being a really important point as part of an underpinning of an all right, the economy is back not only to normal, but we're also not going to have this second wave or this conversation drag on in the fall, and then again we get it next spring. So we're really looking forward to some solution from a pharmacological advance standpoint. That said, I do think that we do need to look at market levels, and so the market has come quite substantially off the bottom. Remember, if the market goes down 50%, it has to recover 100% of those losses. So it's not, if the market goes up 50 when it was down 50, it can't just recover that 50%. So 50% decline from 100 would be 50. And so in order to get back to 100, you'd have to have 100% increase. So remember, on the way down, it is going to affect how much you actually have to achieve on the way back up. I think this is a really good slide just to kind of keep in the back of your mind. Quite honestly, I have this slide on my desk for the last month now, just kind of looking at it, but it looks at best, middle, worst case. And so I'm looking at end of April, end of June, and end of December, and what we can look at in terms of think through in terms of where the market might be. In terms of a short-term end of April, so we're talking a week now, I would say that the market will continue to be more volatile. So no surprise there. The market went down 1,000 over the last couple of days based on what's taking place with energy. We had a $500 billion package passed, and we've had some volatility wrapped around that. All of this fiscal stimulus is what is called when the president and Congress pass these different bills, is supporting the market. So it is supporting it from continuing to go down as significantly as it went down at the beginning. So you're seeing moves less volatile than it was at the beginning, meaning you saw moves of 3,000 points, whereas now you're starting to see moves in the 600. It would be really nice to start to see 200 and 300 point moves, which would be more normal for the markets. And it would also tell us that the markets are getting back to normal. But towards the end of April, we would not, and to the question, is this the right time to invest? We would say that the market would be quite sideways, not only through April, but probably even through May. Is there a retest coming of the lows? I think that's a possibility from a probability standpoint. As these fiscal packages come through, it's probably less probable, but it is possible. And certainly as market volatility has increased, you just need to watch for that. And certainly that's why there is a secure phase, and that's why risk management is done very actively in terms of those secure portfolios. But it's really important to think about the end of the year, because the Federal Reserve has a lot of stimulus that they've put into this market. There's a lot of fiscal stimulus in terms of what Congress has put into this market. Interest rates are now starting to trend towards zero. I would say that favors equities over fixed income, and that favors those that are in equity markets, even when we're talking 9 months, 7 months out. So we do think that equity markets will be quite strong at the end of the year. That said, I think what we're finding, a lot of you have been through the last 30 years. Well, let's just take the last 20. You know, if you retired in 1999, you dealt with 2000, 2001, 2002, and that recession. You dealt with 08 and the great financial crisis, and you dealt with 2020 and the global pandemic, which statistically just should never happen to a retiree, but it happened to you. And so I would say this, as we push forward with our equity investments, I think we just need to realize there's going to be more volatility. And I think that's why the secure phase and also the enjoy phase will have more active risk management associated with it. So with that, let's stop and ask for some additional dialogue and questions. But that hopefully that gives you some context around what we're looking for. Remember, in terms of corporate, consumer, and the cure. And we're looking at about a 2.5 month time frame, and the market should discount that faster than what the economics will show. The economics will still continue to show weakness, even though the market will still continue to show strength, because uncertainty is starting to get defined, which that translates to risk, and that's something that we can manage.
I think that's perfect, Robbie. I think, the big thing now, for our clients is, what does this mean to me? If I'm in the build phase, if I'm in the secure phase or the enjoy phase of my journey, how does this impact me and the goals that I have during that time?
I mean, it definitely means that you're going to need equities in your portfolio. So, the 80s are gone where you could get bonds, double digits, let's say, and even into the 90s. I think it's going to be really important to have equities, but it's really going to be important for you and your financial advisor, whether it's Nick or Brian or Todd or Brad, to be talking about market volatility, because it's really important to know when you need the money because of the volatility associated with just investing. That said, I think equity investors will be rewarded over the next 9 months, as I said, but over the next several years. Interest rates even when you look out, interest rates don't appear to even go up in the next 3 to 5 years. So the Fed has them pegged around zero. I would expect them to come down and trend down with that. So from a retiree standpoint, you're going to need something that drives longevity, and certainly that's going to be equities. In regards to portfolios, if you're trying to build wealth, I would suggest that the domestic marketplace is going to be stronger over internationals. But that said, when we talk about internationals, I just want to make a distinction because international markets typically is this dichotomy between emerging markets and developing markets. So what's an emerging over developing? Developing is Europe. And so Europe is really a hard market to suggest that it's going to be, that it's going to have some substantial growth unless something occurs with the euro. It should be substantially cheaper to travel there, obviously, when things get turned on, but it won't be because of the euro. And that the elevated price of their currency is just artificially suppressing countries like Italy and Spain. But not to belabor that, just to say that what you're going to find is the investment opportunity is going to be more in the emerging space. And that's where those build portfolios are really positioned. So you're going to see this domestic international balance, but you're going to see them weighted more towards the emerging side less towards the Europe side for the fact that we just talked about in terms of growth prospects. Certainly, China continues to grow, and it's the largest emerging, if we can use that moniker, country in the emerging investment space. So from our standpoint, when we're looking at the planning sequence and we're looking at what are clients actually saying? So what are you trying to ask? Are you trying to grow wealth? You'd be in the build stage. Are you trying to preserve it or protect it? You'd be in that secure phase, and that's the pre-retiree phase. It's taking you a lifetime to, build this up, and you don't want to lose it. Or are you in this enjoy phase? And so, we talked about equities being important across the whole curve to drive wealth, but we also talked about volatility and just knowing from an expectation standpoint that it'll be elevated. I would even say it's going to be elevated in terms of fixed income. So the fixed income of the past is not going to be the fixed income of the future. So unfortunately, there's not going to be places to hide from a volatility standpoint. So that's just from an expectation standpoint, something that you're going to have to just digest. That said, you should not see volatility like you saw it over the last month and a half. I would picture that as more the roller coaster that you would never get on versus a roller coaster that you might get on and enjoy. So there's a pretty big difference of volatility that we see out there. Any other questions from you guys?
Are we getting any other questions on here?
Mm-hmm. Robbie, I think probably the biggest thing would just be, kind of, just in I guess in a 60-second, I know that can be a challenge, but a 60-second wrap up, I guess. What do you guys, at Horizon see as, as the outlook as we move forward here, just as a quick leave behind for everybody here?
Yeah, I hope I was optimistic. I mean, as a leave behind, I would give you this framework of are we going to see small businesses fail? And if we start to see that, I think that'll be a dangerous sign. I don't anticipate this. I do think that there's enough balance between states trying to open up and the need for distancing and the need for this watchful eye on what's occurring with our health. What's really important is what the U.S. Treasury Secretary said, Mnuchin. He said April 9th, so this is a couple weeks ago, said we are going to be open for business mid-May. So I'm going to take the U.S. Treasury Secretary at his word. You're starting to see the dialogue switch in Washington, especially in the press conferences that you're probably watching, start to see that the dialogue is changing and shifting to now how to reopen. That said, I'm pretty optimistic in terms of the investor that if you can stomach some of the volatility, you will be rewarded, whether you're in build, secure, and enjoy. But it's really important to stay in touch with, our friends at Lerner, Cerny, and FAP, because it's really important that they understand when that wealth is needed for whatever goal or whatever outcome you're trying to achieve. So I'm cautiously optimistic, but I'm listening to the Treasury Secretary and his words, and I'm going to take him at his word right now. But I think Big Rapids and Charlotte are on their way to recover. They're not at the beginning of this, and they're not in the middle.
Perfect, and we really appreciate that. Thank you, Robbie. Thank you, Danielle. We really appreciate our relationship with you guys at Horizon. Thank you to everybody that was able to join us today. I think we got a lot of really great information. It's nice to hear perspective on all of these issues, so we definitely appreciate that. We will plan to send this presentation out as well on email, posted on social media. So if you know somebody that wasn't able to attend or just want to share it with some of your colleagues or friends, we'd love for you to do that. But the biggest thing is that if you do have any continued questions, anything that you guys want to discuss further from this, about the market, whatever it is, make sure you reach out. That's why we're here. We're here to answer your guys' questions, and we appreciate your trusting in us to do that. So thank you, and we appreciate you joining us for this webinar today.
Thank you, guys.
Thank you very much, Robbie.